Hi, today I'm going to talk to you about a secret in the fund management industry that I think is putting millions of people's retirements at risk. I'm going to try and explain why it's happening, what is happening, and I'm also going to try and give you an idea about what you can do about it. So the secret is risk control, or rather lack of risk control. The reason it happens in the fund management industry is the industry has learnt over a long period of time that the way to attract new assets and new clients is to perform well, but that people don't judge the performance properly on a risk-adjusted basis. So the higher the risk of assets that you have, on average, the higher the return that you should expect. So all else being equal, if you want to generate better returns and you always run higher risk than the people that you compete with, you should perform better over time. Now, from a fund management company standpoint, that is actually a winning strategy. But from a client standpoint, it's extremely dangerous. Over the last 20 or 30 years, every recession that we've had, we've recovered from it quickly. So it's easy to forget the pain of the losses during the downturns. But there is no guarantee the next time the market falls that it bounces back so quickly. And it's a genuine risk to people as they're approaching retirement that higher risk could stop you from meeting your objectives. Now, how do fund managers do it and what should you look out for? Well, if you thought that your asset allocation, the neutral asset allocation to meet your objectives should be perhaps 60% in the stock market, that would be a balanced fund, and 40% predominantly in bonds. Now, you as a fund manager can't put 80 to 100% in the stock market. Once there are losses, you will get sued by your clients. That's not a winning strategy. But what you can do is you can turn every dial within the portfolio upwards in risk. And the cumulative effect is a very large change in the overall risk of the portfolio. So, for example, you can always be 63 to 65% in the stock market rather than 60. And rather than having all of your money in developed markets like the UK, well, you can run a large emerging markets position. Or you can have a large, smaller company position. Both of these things have higher expected returns, but are quite higher risk and will fall more in recessions. Similarly, on the bond portfolio, rather than having boring old government bonds, which tend to have a lower return but go up when the stock market goes down, you can have high yield bonds, which are still bonds, but they act more like the stock market, much higher risk. Or rather than having bonds at all, you could substitute with property or absolute return funds, all of which could fall within loosely your bond portfolio, but they've got very different characteristics. Now, if across your portfolio, you regularly turn all of these dials upwards in risk, the cumulative effect will be a much bigger fall when you have a stock market decline. And of course, as I said earlier, if the decline isn't followed by an immediate bounce back where there's no guarantee that it will be, I think you could find or will find that many people can't meet their objectives. Now, what you can do about it is obviously you have to control risk well. But as an investor, I think you should just be much more conscious of risk-adjusted returns. So look at things like how well did the fund do compared to its peers, or what you might think a neutral performance would have been during recent times of crisis. So let's say during February and March in 2020 when the COVID crisis was in full swing, how well did a fund do? If it fell more heavily during that period than you might have expected, it's a great indication that the risk control is probably not in line with what you'd like it to be. Now, as a fund manager, I care about risk control more than anything else. I actually think it's the number one job of fund managers to manage risk control, because anyone can produce higher returns by taking higher risk. There's no skill involved in that at all. But to produce high returns and control risk, that's a true measure of skill. So I think you should be looking for a fund manager, and any fund you have, to always have a significant proportion of its assets in the balancing asset that should go up when the stock market goes down. That is really important. And the second thing is, something that we do, is I think you should be conscious about what the emerging risks are. So what are the risks that might come in the next few years that could blow you off track? So today we think there's high valuations in some markets, there's a risk of interest rate rises, and there's a risk of inflation. And somewhere in your portfolio, I think you have to have tried to neutralize that. So I think you need to have this forward-looking view about what the emerging risks are. So if you can cover that, always have risk control, and have this flexible view about what the new risks are, I think you put yourself in a much stronger position to control risk. Now, as with everything I talk about around investments, I must remind you that with investments, your capital is at risk. The other thing I'd like to remind you is if you like the content, around here on the screen, in the Flying Colours logo, if you click on that, you'll have a subscribe button. And if you click subscribe, you'll automatically be able to see the new content that we put out. Thank you very much, and I'll see you next time.